if institutional DeFi is just for institutions, like why does it have to be on a public blockchain? Why not just have a permissioned, if the pools are permissioned, why not just have it all on a permissioned private blockchain?
All right, everyone. Welcome back to another episode of Empire. Today, Santi's sitting this one out. We are joined by Byron, the Blockworks daily newsletter writer and extraordinaire, the Matt Levine of crypto. And we are joined by Matt Blumberg as well, who is on Polygon's institutional team, but does not represent Polygon's views here. So Matt, Byron, welcome to the show, guys.
Thanks, Jason. Yeah, first time caller, long time listener.
Good. We'd love to hear that. I want to focus this conversation really on the JP Morgan news. Matt, we want you to break it down for us. Here's my understanding. So basically this week, JP Morgan announced that they have executed their first live trade on a public blockchain. The details are that they I think alongside DBS Bank and SBI, executed a trade that involved a tokenized yen, JPY, and then SGD, which is Singapore dollar deposits. The trade was carried out on a modified fork of Aave Arc on Polygon, so that the interest rates, and then they basically modified the fork of, they forked Aave Arc so that the interest rates and the FX rates could be manually set, and then they used Polygon so that it was a bit cheaper. There are also a bunch of other firsts here, right? The transaction involved like VCs, verifiable credentials, which allowed the actual users to prevent the kind of KYC to have like the necessary compliance information for the third-party verifiers. I think there are a bunch of firsts here, but Matt, can you just break down this whole transaction, this whole trade for us?
Yeah, so this is really part of an initiative that was set out by the Singaporean government's like financial arm, which is the Monetary Authority of Singapore. It's like their SEC and CFTC and like everything like rolled into one. And so a while ago, they came out with this initiative called Project Guardian, which is meant to explore the potential benefits of asset tokenization. And so, one relatively straightforward use case is like foreign exchange, right? Like we're all here for cryptocurrencies, right? The way that it worked was, when you have like large financial institutions, or really most kinds of tokenization are going to involve some sort of KYC. Whether that's like attesting that you're like a US resident, or like, an institutional investor, or a qualified buyer, or a financial, counterparty, or whatever. The KYC elements of this actually wind up being like where a lot of the innovation and like tech happens. And so, first, I guess we should talk about like Aave Arc. So this is like Aave's like permissioned product, where it allows permission parties to participate in Aave like borrow lend markets. And so it introduces this notion of like a permission pool, where you can only take part in this pool if like you meet certain credentials. And then the innovative part that you were talking about a minute ago is this notion of like on-chain verifiable credentials. So, this could be as simple as like having a list of addresses that are allowed to interact with whatever contract. But it can also get like much more complicated, right? You can imagine like financial institutions of a certain jurisdiction can touch one product but not another. Maybe, one financial institution is allowed to interact with a set of counterparties but not another set of counterparties, even if they fall into like the same broad categorizations. And so you wind up with like relatively complex logic, and that's where this like verifiable credential thing happens. And the innovation here is really that the verification is happening on chain using using criteria that are set out on chain as like directly exposable on chain elements, almost like soulbound NFTs, right? Where that way you can write up your own contracts without having to like get directly in touch with whatever third parties, and you can use this sort of like third party like KYC like accreditation library of credentials, and then you can reference it for like whatever you need to, right? So in this case, it was pretty simple. There were like 3 banks involved. It was like DBS, SBI, and JP Morgan. So it was like relatively straightforward. But going forward, you can imagine like maybe a pension fund wants to buy something that's, some product that's offered by one of these banks, right? They might have to reach like whatever set of credentials, and you can bake that logic into either like the contract or the marketplace or the borrow lend market, where it's going to take place. So that's a little bit on just like the credential side. In terms of the transaction itself, there's actually like a great tweet thread. We should link it in the show notes, from a guy, Ty Lobban, who works at JP Morgan's Onyx group, which is their like crypto. I thought this group totally got spun down in like 2018. I'm like,
I did too. I remember.
Yeah.
I remember when Amber Balday was leading the group, and then obviously Christine Moy had a big impact over at JP Morgan. But I remember Amber was working on Quorum, if you remember Quorum, the fork of Ethereum back in like 2015, 2016, 2017. Consensus came around and I guess kind of bought Quorum. So yeah, there's a long history obviously of JP Morgan and blockchain here.
Yeah, and then I think Quorum may have even like passed hands over to Microsoft. I guess their Azure blockchain product lives on as like Quorum now, which is just, like totally wild. But anyway, yeah, obviously kind of ironic given Jamie Dimon's like wild tirades on Twitter. But JP Morgan's like done a fair amount of building and innovation here, right? So this like specific trade, you can go into like you can actually see it on Polygon Scan, which I absolutely love. I always love to check the chain, right? And so if you dig in, you can see that there was like a permission pool, a slightly modified version of Aave Arc, right? So Aave, the pools, they have parameters like whether a liquidation should occur at whatever point, like what the FX rate should be considered. Should it be using an oracle? Should it be like some kind of fixed rate? What should the interest rates be, right? And so they deployed this like modified version where they could set those parameters. And I think the idea is, it's a proof of concept, right? So they're, maybe really not trying to like get liquidated on, on this like version of permissioned Aave that has 2 assets and 3 parties, right? But they set up this pool, and then they effectively tokenized Japanese yen and Singaporean dollars, and then it looks like it was kind of structured more as like a bilateral like borrow lend thing, where one party deposits like tokenized SGD, another party deposits like tokenized JPY. They borrow against each other using that like fixed like on-chain FX rate. And then like whatever terms they use for interest rates as well. So you can imagine like if you're a bank, like maybe you need like some number of Singaporean dollars for some reason for like a day, or for like a week or whatever. And historically you've done this over the counter. You would call up the FX guy at the counterparty bank, and they would tell you, hey, like here's my pricing, here's my interest rate. And with this, you can do it all on chain. Which is pretty cool. It makes like the transfer and custody and all that like way simpler, but it's just a trip to see like these token names, right? You have like JPM SGD, and then you have like the Aave, a JPM SGD. It's just something you're not really used to seeing, right? So that's broadly speaking how it works. So it used Aave for a couple things, right? There's they sort of tacked on their verifiable credentials to the Aave permission pool like construct. And then they also use that as the borrow lend market for executing this transaction.
Got it. Let me do a little recap of that and just make sure that I have everything correct. So basically, so Singapore's got this initiative, right, to get deeper and deeper into crypto. The Singaporean government's been very interested in crypto for many years now. They came to JP Morgan. What JP Morgan actually did is they basically tokenized these deposits, right? So they tokenized SJD or SGD and JPY. They built an Aave pool basically. They use, I think it was Worldwide Web's like verifiable. They built verifiable credentials using World Wide Web to provide this like compliant access to Aave Arc, which is the kind of like permission DeFi side of Aave. And they allowed them to basically swap the SGD for JPY using the permission to Aave Arc pool. Am I following that correctly?
Yeah, it looks like the construct was a little bit more of a borrow, like, a loan rather than a swap, but yeah, pretty much. Yeah. And, you know, the idea is like today we're using this W3 like verifiable credential, but like tomorrow we could use something more composable, like, you know, zero knowledge proofs, right? Where like it preserves that privacy because not every bank wants to have their outstanding like loan book directly visible on chain, right?
Right. And I think Ty actually said that in the tweet thread. He said that we designed this in a way that ensures verifiable credential based compliance checks can be used with any DeFi protocol without the protocols needing to know about the verifiable credentials, which is really cool, right? Because it kind of frees the DeFi front ends from needing to do these KYC checks. But also, he said we think that our on chain VC verification is another first. The design isn't perfect, and he actually said in the future we want to use zero knowledge proofs. So it's pretty interesting. But Byron, I'd love to get your take as someone who's just worked inside of some of these large institutions for a number of years. Like, what's your take on this? Is this exciting to see? Is this like a little bit of skepticism? You don't really know what to think about this. You just have more questions for Matt. What's your take on this?
Yeah, I think it's super interesting, and I'm very curious about it. But like I've read I guess there was a white paper, and some tweet threads and things, and I can't say that I totally understand what they're going for. So yeah, mostly I just have a bunch of questions. I think my first question would just be, if institutional DeFi is just for institutions, like why does it have to be on a public blockchain? Why not just have a permissioned, if the pools are permissioned, why not just have it all on a permissioned private blockchain?
It's a good question. I think there's a couple of reasons, right? So the first is like you can have a much more trustless system if you have like, you know, credibly neutral validator sets, right? And so, you know, there's a question of like, where do you draw the line on like who's institutional, right? Like if you're like a high net worth person who's trying to trade a JPEG or send a fair amount of like, you know, money to someone, then like having, you know, like, yeah, you can do it through a bank and it's effectively a private blockchain, right? But you might feel more comfortable knowing that like all of the logic's being executed as intended, being able to like read through that contract and then being able to see that it actually makes it like onto a chain. It makes it a little bit more like permanent, I guess. So it helps like the trust assumptions a little bit relative to like the, you know, we've all heard like a lot of talk around like, oh, like what if all the banks just ran their own blockchains, like a Ripple model, right? But you know, having this like credibly neutral set of validators makes it and you know, we can get it's a weird time to be saying the words credibly neutral validators, but you know, hopefully that's the vision, right? And then, you know, the other thing is really from a regulatory perspective, a lot of financial institutions don't really or can't really get into the game of operating what looks like an exchange. And so being able to like outsource the legal liability is somewhat valuable too, right?
So you mentioned high net worth individuals. Do you imagine that retail customers of the banks will be able to interact with the banks on these blockchains? I was kind of working on the assumption that it was going to be just, banks versus banks.
So I think like for asset tokenization broadly, right? There's like a spectrum of like what people can and can't do, right? So, you know, I don't think like individuals are going to be like providing liquidity to like the JP Morgan Singapore dollar, JP Morgan JPY pool anytime soon. But you know, you could imagine if you're raising a fund, right? Like, so, and something that you would typically sell to say financial advisors, right? Like like a VC fund or a private equity fund. And then you need those like financial advisors to like distribute your product. There's a middle person there. But you could potentially go direct to customer, right? Like if all you need is that assurance that the customer is legally allowed to buy and sell your product. And so, you know, you can imagine a world where like we have tokenized XYZ products and the users go through an app or like a you know fintech front end that executes those trades on their behalf, because the front end, really their primary value in this world would be that they actually execute the KYC too, and they hold track of the database of like who's allowed to touch what. But you know, like asset tokenization is a weird one, right? Because there's so many different kinds of assets and so many different kinds of permissions you have to have. But you know, I'm broadly bullish that like we can get to a place where it's not just like three banks interacting with each other, like trading FX. It feels like a toy now, right?
Yeah, I'm kind of assuming that it's mostly about kind of cost cutting on interbank transactions. But it sounds like, that was kind of my impression from reading the white paper. But it sounds like you think it could be a lot more than that.
Yeah, totally. I mean, you always have to ask yourself, like, how much cost do you really cut, right? Like, when do the gas fees pay for themselves? And like, when do the smart contract developers pay for themselves? And when does the smart contract risk like become like underwritable, relative to like employing three people, one at each bank that are going to like call each other over the phone and like execute those settlements. But the way I understand it is that like a lot of assets, when they get passed from one institution to another, it actually does incur a fair amount of cost on the back end. There are like companies that provide those like asset transfer services that tend to take a reasonably sized chunk. So yeah, it's one part cost, it's one part just like assurances that like that third party is not going to like mess with you, and then one part like broader financial access for albeit like in a not fully permissionless way, it's still broader.
I think a lot of the cost cutting would also just be in the atomic settlement, right? So then that would remove the need for every single participant having like large deposits sitting around. Um, so
Yeah.
do you think there will ever be touch points between institutional DeFi and the rest of DeFi, or are these going to be just completely different parallel systems?
I mean, now we're getting philosophical, but I would hope not, because I think it's really important for DeFi to exist in a format that looks like what it does today, in a permissionless, like just just you, the contract, and the rest of the world being able to interact with it as you please as like individuals. And then I think institutional DeFi should exist in its own little bubble. And my fear is that like as in a world where those touch, institutional DeFi just like severely overwhelms it, and we lose a little bit of like the permissionlessness that makes this important.
I have a
Yeah, that was
feeling
kind of
that
my
yeah. So sorry, Byron. I just like one thought on that, Byron, is I don't know if you guys listen to the Erik Voorhees, Sam Bankman-Fried podcast on Bankless, but if anyone's listening to this and hasn't listened to that, I'd really recommend it. It's a really interesting conversation. But I think you could see a world, not that I hope that this isn't the world that we see, but I think you could see a world where um, DeFi, like permissionless DeFi, is like the playground, right? Like right now, if you want to go build financial products, it takes years to go build financial products. In DeFi, you can build a financial product in days or weeks, right? So you could have DeFi as this like playground of financial activity, and then once something feels like it's getting big enough, or once something you almost want to like take it mainstream, it goes into that like that. I like hate to say this, but the permissioned DeFi world. And again, I really hope this isn't the world that we end up living in. Because I do think all this stuff should be permissionless. But I don't know. I'm just reading Ty's tweet here. It's like tweet number 4, tweet number 5. He said, sidebar, as a heavily regulated bank, we cannot enable money laundering and must undertake KYC. Using verifiable credentials and allow lists was crucial for us for enabling us to use DeFi pools with certainty on these points. Institutional DeFi exclamation mark. And that just tells me it's like, I don't know. I even saw the folks who are participating in Aave Arc. From the get-go is like GSR, Ribbit, QCP, Wintermute, CoinShares. Like these are pretty crypto native funds, and it's like I think even these crypto native funds want to participate in this KYC AML'd part of DeFi. So
Yeah, it's a weird state that we live in, right? Where like if you're like a Wintermute or a GSR, like on one hand you want to encourage like permissionless innovation as much as you can, but on the other hand, if you have like a profitable opportunity to take in the permission part of the world, then like you gotta take it, right?
yeah, Byron, what else? I cut you off before.
Um, yeah. So, like, do you think this is going to be something that gets a lot of attention in the DeFi community, or is it going to be like sort of like JP Morgan coin, like, that's nice, but it has nothing to do with us, really?
I mean, it's tricky, right? Because there's two sides of the DeFi community, and the one that makes the noise is like the speculative side. I think like you could probably say this about like a lot of crypto applications, right? And so like, where's the speculation in like JPM coin that like I can't participate in as a user doesn't really land. But then I like when I first read about all of this stuff, I read about it from a place of like pessimism and negativity and doubt, because we've had so many years of so many announcements of things that quote happened on chain, and like never had like the transaction hash, never actually had, you could never check the chain and verify that any of it happened. I think the ECB like tokenized like euro bonds like a year and a half ago, but like which blockchain, they didn't tell us. Right? Like you know, like how did the bonds work? Are they were collateralized? No real info, right? So you know, it's a little interesting to see something that actually legitimately happened, you know, to a degree. There's a lot of trust, right? Like, does JP Morgan actually hold the SGD to like back up these liabilities? You know, but when like institutions are actually like pressing the button to like send transactions on chain, that's a big step. And, you know, I don't think we've seen anything at a similar level of like real actual participation from traditional like banks, right? So I don't think it's going to make waves, despite it being like kind of a big deal. Like the fact that these guys have wallets, right? The fact that they have private keys and they're figuring out how to like what the best practices are for like custodying and all of that. That's pretty meaningful. But yeah, I don't know. I don't see it making waves in the DeFi space or really in the institutional space. Um, I don't know. I think that this use case is really small is the other issue, right? Like if you think about like, okay, Singaporean dollar, Japanese yen, some kind of like loan, it's not, you know, it's not like meaningful to your average person working at an institution who doesn't really have to deal with like overnight FX rates, right? Like it's, you know, it's a little bit like neither here nor there, but you know, maybe the next one is a lot bigger. Maybe it's like a, you know, a money market fund or like commercial paper, or like, you know, like slowly we'll start getting bigger and bigger things. Um, and, you know, now that sort of these companies have like the mindset and tech in place to actually execute stuff on chain, you know, you can imagine it getting like snowballing really quickly. Like it feels a little bit like the hard part in the infrastructure is there. And we've seen like signals, at least, that there is institutional comfort. You know, it's not hard to imagine like, you know, it's a little bit like the iPhone, right? Like the hardware is there, the app store is there. You know, building the application is just software. Obviously, building software is hard, but you know, it is just software when like you already have like the full supply chain in place.
Do you think there's a risk that regulators will look at this and say, oh yeah, we like that, we're totally comfortable with that, that's allowed, and that's the only kind of DeFi allowed, so now we're just going to just ban all the rest of DeFi? If you don't have these verified chain KYC things, then you can't do DeFi.
Oof, that would be brutal. Yeah, it feels like there's a risk of that, right? I don't know. What do y'all think?
I think that's a possibility. I would take the other side of what you just said before, though, Matt, about you're like that this isn't that big of a deal and that people don't care about it that much. I think this use case is incredibly small, obviously, but the most interesting thing from this, in my mind, was that was just seeing Ty's public thread and seeing you can just read between the lines and see how knowledgeable he is, and how inherently how knowledgeable that team must be when they're talking about when you have JP Morgan talking about zero knowledge proofs, on chain verifiable credential verification. I like
Like posting links to Polygon scan, right?
Posting links to
Like
Polygon scan. Yeah, exactly. Like these are not folks who are, you know, messing around on like, you know, just opening up like an Anchorage or like a Coinbase account and like throwing some ETH in there and maybe even like getting crazy and staking it. Like they are changing things on chain, and that's really interesting to me. And what that actually does is, I think it tells the regulators that they need to catch up. So I think there's the possibility that Byron's right, and the regulators say, "Ooh, this is a really nice version of DeFi. Like we can get comfortable with this." There's another thing that happens though, where a regulator looks at this and says, "Okay, ZKP, what the hell does that mean? Oh, zero knowledge proof. Oh, this is actually zero. Oh, okay." And now I'm going to try to actually understand what's going on with some of this stuff. So I think it's just what they're doing here pushes everyone else to just speed up their the amount of information and knowledge that they need to have about what's going on.
Yeah, I think to that effect, like Singapore is doing the world a huge service, right? By being so crypto native or crypto forward, right? Like, when I was talking to people in the UK, they were like, yeah, like our financial authority is like issuing like, licenses to people to like run crypto funds, right? You don't see as much of that in the US, or like, the whole thing feels like much clunkier and you don't have access to the same opportunities. And having JP Morgan, participate in this experiment is like, whoa, hang on, maybe now every regular needs to think a little bit harder about how they're actually going to engage with this stuff.
Yeah, Matt, I want to ask you a couple questions here. One is, why do you think that they chose Aave Arc instead of Compound?
I don't know. I think, when it comes to Aave, right? Like, we have the PayPal Mafia in Web 2. Like, I really think the Aave Mafia is going to be the Web 3 version of that. They're just like engaging a lot harder on a lot of different fronts, like Lens Protocol on one end, right? And then you have like Aave Gachi, right? And then you have Aave Arc. I think Aave Arc was actually like a big deal. Maybe, I don't know if the product really has much TVL or usage or like good opportunities there. But as a press release, it made a huge impact, right? Now it's like every institution's familiar with Aave Arc, right? It is like the optimal like way for, if you're a traditional like finance shop, that's the, about Fireblocks and about Aave Arc. Um, that's my take.
I have another question here, which is, uh, when will Polygon? I feel like Polygon's had a huge week, right? There's other big news that we could talk about, which is Instagram rolled out minting for NFTs. Polygon is like the blockchain they chose from that. When, and again, I'm, I know you're biased here because you work at Polygon, so I don't know how much you can say about this, but I'll just reinforce the fact that you do not represent Polygon's beliefs here. When do you think Polygon declares independence from Ethereum and becomes its own L1 in order to capture more value for Matic holders? Options could be next couple of
I think
years, 5 years, never. What do you think about that?
if you look at the Polygon product suite and like everything that's getting built right now, it doesn't look like that's the plan, right? Like, Polygon effectively launched this layer one on its own with the full knowledge that like, or call it a side chain, commit chain, whatever. And I'm gonna get shit for not calling it a layer two, but it is a layer one, right? Um, and that was like the stepping stone, right? Like there's a reason why we raised all this money and are sinking it heavily into zero knowledge technology, right? Because we do want to build the ZK VM, which just went into testnet a few weeks ago, right? Which is our like ZK roll up. I think Ethereum, it's already like, I was having a conversation with someone the other day, like, why does Bitcoin have value? And it's like immediately apparent to us, if Bitcoin was one of the key ways that you got into the space, obviously Bitcoin has value, right? That's just like a no-brainer. But for someone that's entering not through Bitcoin, it's a much more confusing space, and you don't understand why Bitcoin is at number one in terms of market cap. I think Ethereum has reached a similar level of like Lindy effect, where it's here forever, right? And it is going to like serve as that global settlement layer. And there's advantages to that. You need your staking token to be like as high value as possible to have maximum security on the network. And so there's an advantage to like having everything sort of like converge on Ethereum as the settlement layer. And if you look at like Polygon's tech, like basically where we're investing our time and money and effort is in ways to scale Ethereum rather than like serve as an alternative. I mean, you can even see it in like Sandeep's tweet about Instagram. He was like, "We're bringing Ethereum to the world," right? It's just like very aligned, and that's been advantageous for Polygon from the crypto native side, because if you're a crypto native builder and you would have built on Ethereum 3 years ago, but then you saw what happened in gas prices this last cycle, and now you have to rethink things. If you're your natural first step is likely Polygon. And then if you start thinking about another EVM compatible chain like Avalanche and Phantom and Harmony, like it reopens your world. Now you have to near, right? You have to rethink a whole lot of things. Versus like Polygon, it feels like scalable Ethereum. It's like, it's the best like
Yeah,
tagline they could have.
I'm just thinking though, like how much of that last sentence I think is one of the most important sentences. I'm trying to think about how much of this is marketing because So you remember? So last summer, Polygon introduced Avail, which was like their, I think they called it like the robust, general purpose, scalable data availability buzzword. Like basically, they're building their own data availability layer, right? And once that's live, I don't know what stage it's at right now, but like once their data availability layer is live, it makes me think like, what do you need the Ethereum L1 for? In my mind, what you need the Ethereum L1 for is having the whole community continue to love you. Because once you move off of that, and once you settle back to your data availability layer, now you're now you're kind of in the bucket of like Avalanche and Solana and things like that, where the ETH crowd doesn't like you. But right now, the when your roll ups are settling back to Ethereum, the ETH crowd likes you. Do you know what I'm saying?
Yeah, I do. And I'm like admittedly not as educated on data availability as I should be. But I think it's really about security at that point, right? Like your data availability layer still has validators, right? It's like its own blockchain of blockchains, right? It's a little bit more verifiable because you can take like subsampling or something and have like more like you have like clients like more directly participate in validating the chain. But you still have to have some kind of staked token or something, or a similar model. It's Polygon Avail is like still very much in R&D phases, but
Yeah.
you still need some security, right? And I think the reason we haven't seen more talk around separating out the data availability layer is that like the rest of the world isn't quite in a place where we necessarily want that yet. And you can even think of like the beacon chain as its own data availability layer, right? But it's like the highest security one, where like once we get sharding and we get like more slots and all that, it's it becomes like a place that blockchains post data, like that shards of blockchains post data or whatever. Yeah, it's a good question. How much is marketing? I think everything in crypto is primarily marketing at this point.
Well said.
I mean, we're discussing a
Byron.
press release, right?
True. Well said. Byron, any other thoughts or questions on the JP Morgan side of things, or on Polygon? Really, anything else that's on your mind right now?
I don't know. I guess one question I had was about the scalability. So I guess one of the selling points or talking points was that this solves the scalability problem of stable coins. And I wasn't sure exactly what they were referring to. I think that was in the tweet thread that Jason mentioned before. Do you know what they were referring to there, Matt?
Boy, I got to tell you, it feels like the opposite, right? Because this is like a stable coin that like two parties get to interact with. Like, I know exactly what you're talking about. It was like the second thread. It's like, look, we have JP Morgan SGD, which solves the problem of like deploying stable tokens without incurring the scalability issues of stable coins. Like, what? I do think scalability in terms of gas is important though, because if you think about these like on-chain verifiable credentials, this stuff gets really complicated really quickly. If you're like an asset manager and you're trying to like tokenize some financial product, like you might have like today you have like pages and pages of legal documents specifying exactly what needs to happen in order for someone to be able to buy it, right? So being able to like have this like arbitrary like verifiable credential, it's not really possible directly on the L1, because what you don't want is you don't want institutions coming in and being like, yeah, I'll trade you some JPY for SGD. Okay, great. Like, and then they go on chain, they're like, oh my god, the gas fees, right? Or like someone's trying to deploy a contract and like maybe it hits the gas limit, right? So I think going to Polygon is basically for that reason here.
So the going to Polygon is for the reason that it's for
just like the cheaper gas, like what you're getting, right? Yeah. Like you're not going to hit a point where like you have some workflow where you settle some things on chain today and then you try to do it tomorrow and like all of a sudden gas fees are 8 times more expensive because like art gobblers are going wild.
But there must be a security element too. Like how did Polygon convince JP Morgan that their security was sufficient for institutional sized banking?
I think when it comes to security of like any like proof of stake system, it's about like the staked assets, right? What trust assumptions do you have to make, etc. I'd expect a lot more of this institutional stuff to go to ZK rollups in the future, to be honest. Like this one obviously launched on the existing like layer one because, you know, people wanted to press ahead and get things done. And like, you know, that's a core part of the industry, right? But yeah, I think this stuff's going to live on like, you know, gas efficient ZK rollups in the future.
Could it be on multiple chains? I feel like the way I conceptualize it is it's all these banks agreeing to share a database. Basically, like the essential problem is that they all keep their individual databases, and then when they trade with each other, they all update their individual databases. Then they have to hope that they updated them the same way. So my assumption is that like the benefit of institutional DeFi is that they'd all be sharing one big database. But then if it's on multiple chains, that would kind of defeat the purpose, right? So is it, is institutional DeFi is it going to be just on one chain, do you think?
Yeah, I think so. And I think you're seeing like a pretty big marketing push from both Avalanche and Polygon on that end, right? Like Avalanche's mission in life is to, you know, tokenize the world's assets, right? And, you know, to a degree, like you can see in their marketing, right? Like Avalanche was buying out like subway cars in New York City, which was absolutely wild. And then they bought like the train cars that went between New York and Connecticut, right? Like you know, they've made a pretty heavy push in the institutional space. I think Polygon, at least, you know, from what I've seen, is attempting to play in a similar space. And it's going to come down to business development.
Okay, and you said they're tokenizing assets, but that reminds me of my other question, which is that JP Morgan said they've tokenized liabilities of the bank, which I don't totally understand. Like, in what sense are these liabilities in the bank? Like, if I have a bank account with JP Morgan, that is liability of the bank because I can go to an ATM machine and get cash, and they have to give me cash. But I don't really understand how that works in the context of a blockchain. Like, I can't go to the blockchain and get cash, and I can't go to I can't take their tokenized JPY and send it to some other bank. I don't think so. Do you have a sense of in what sense these are tokenized liabilities?
The way I read it is it's basically like a stable coin that's represented by by like a Singaporean dollar in a bank account somewhere, similar to like Circle, right? Like each USDC is like a liability of Circle, and that can be like redeemed for a US dollar.
Right. So I guess I understand the redemption mechanism at Circle, but I'm not sure what the redemption mechanism would be in institutional DeFi. I guess that's kind of my question.
Yeah, I mean, in this example, you know, there's there's three parties, and they go to each other at the end of the day, and they say, "Nice job on the tokenization experiment, guys. Can I get my Singaporean dollars, please?"
Right.
You know, who knows, right? Like that there's a whole bunch of trust assumptions there too, right?
Cool. Matt, anything else?
No, thanks. This is the most fun I've ever had talking about institutional DeFi.
You and me both, my friend. You and me both. Matt, anything else from this week that just really stood out to you? It was a surprisingly active week just for the bear market. Like everything going on with Instagram and their NFTs. There's actually a lot going on with NFTs right now. Instagram and their NFTs. Twitter's rolling out the ability to buy and sell NFTs directly from tweets. Art Gobblers also had an interesting week. Anything that's just top of mind for you as you think about wrapping up the week?
You know, like the social stuff is so interesting, right? Like because you've got it coming from two ends here. You've got like the Lens protocol, like I'm going to directly have a crypto native platform where my users are going to understand what they're doing when they submit a tweet or when they, you know, send a photo to the chain, or like something or collect it or whatever. And then you have the Web 2 side of it, which is, you know, you can link up your MetaMask, you can link up your Phantom wallet, you know, you can directly mint a tweet from the chain. It reminds me of that one tweet. Someone collected the first tweet for like millions of dollars back in the day. This is like the biggest cringe story. Now it's like can't get sold for $5. Like anyway, I think it's so interesting that we have these two sort of competing on ramps for users, right? Like, are people going to be onboarded to Web3 social through Web3 or through social? And when you're onboarding through social, like, you have to really worry about the user experience, right? So for example, like, there's no cost to the user to mint an NFT on Polygon on Instagram, right? And that's like clearly subsidized. I don't know by who, right? But like, are people going to keep doing that when they have to sign a transaction? Like, what's going on with, like, like, you still have to link, I think, a crypto wallet in order to do these NFT activities on Instagram. So, to what degree is like the population using these things really that different? I just think that, like, we need like better private key management solutions for Web3 social to work. Like, when I try to check, like, I made the mistake of minting my Lens profile to like a wallet that's like linked to my like ledger, right? And I'm like, I'm sure I can transfer the profile, but like I don't actually know if there's a good tool for me to do that, and I don't feel like going to Polygon Scan to do it. It's like, now I have to get my ledger out every time I want to check, like, Lenster or Lens Friends or whatever. I don't know. I personally super bold up on social as a way to directly like demonstrate how a lot of the like great qualities that we love about crypto, the censorship resistance, the composability, that sort of like, like you were saying, Byron, like that one database where everyone comes together and agrees on things, right? So it's really interesting to see the big Web2. I feel like it's been a week of just like big companies that like weren't touching crypto before taking some big steps into crypto in general.
Yeah, agreed. I mean, I don't know if you listened to that episode we did on Empire earlier this week with Arbitrum, but it was interesting. Arbitrum's team came on the podcast with Santiago, and it was just interesting hearing them talk about how the whole Reddit deal went down. So that's not a new thing. Like, they put out a call, like an RFP, actually, I think a year and a half or 2 years ago, saying we want to launch this, like, putting some data basically on a blockchain. And I think like 15 different companies or organizations competed on that, and Arbitrum actually won it. And they've been building that for like 15 months. And so now it's finally live. So I think there's a lot of stuff. And even with this JP Morgan thing, I mean, people say institutions move slowly. This is one trade 10 years in the making, right?
Yeah, I mean, and you fast forward 10 years, right? And it's like, today you have a big enough core group of people within JP Morgan to get them to participate in something like this. But in 10 more years, half of the employees at JP Morgan have a Lens profile and have interacted with the chain in some way. And, you hit this tipping point really quickly where suddenly it's like, like, it can come through like larger, like a coup, like an Elon Musk, takeover of Twitter, or it can come like slowly from within, but you hit this like core density really, really suddenly. And, it's going to be pretty cool to see how that plays out.
Occupy JP Morgan. I think that's hashtag Occupy JP Morgan.
Guys, this is a great chat. Matt, thanks for coming on so last minute. I appreciate it. Byron, this is awesome as always. Go subscribe to Blockworks' daily newsletter if you're not subscribed already. We'll put a link in the show notes. See you guys next time.
Thanks.
Thanks, guys.